Okay, what's going on, you guys? What's going on? Today is actually Sunday, July the 6th, and I'm actually backlogging some stuff from last week when it comes to DRCs. I'm gonna do Wednesday because Wednesday was probably one of the best days of the week, and I would say probably one of the better days of the year. Um, when it comes to the capitulation balance play that I like to play, and just how it's set up and how it had an overnight liquidity target that we like to target most of the time when we wake up around 7 a.m. So let me pull up this chart into this. Like I said, this daily recap will be for um, July the 2nd, which was Wednesday. And then we will also do we'll keep it video per video. So I'll also do the one for Thursday because that was building into, a holiday and then having half days where they were going to cut the markets off half days is really important to kind of see, just the volatility and just, how people are going to be playing when it comes close to like a holiday. So let's stick with Wednesday. I'm going to pull up the chart here. Now I have everything clear because it is the weekend and I'm going to be, doing my end of week review. So this is kind of actually a blessing because you guys can see the full scope of the markup, right? And so I like to look at this from higher time frame to my mid-level time frames, right? Your 1 hour, 15, 5, stuff like that. To over here is more all small time frame on the far right. All right, so we'll go into Wednesday. Now this was a lot higher time frame, so there's a lot of context and location of what we were actually looking for, and which was obviously to see prices continue higher, right? I mean, we had, excuse me, we had all-time highs that we had here on the higher time frames, and we had the month of June just closed. So if you look at that month, we were closing higher than those wicks here. Then you look at the last, week, right, previous to last week. So the week before that, we had that massive push up that, extended us above the supply levels. So we were gonna obviously go and probably make an all-time high, and that's what we ended up seeing. And so you go back to daily, you go back to the smaller time frames that we're going to look at here in just a second, and you can kind of see why this play was, I thought it was just so massive, especially when you're talking about, navigating at all-time highs. So let's go 1 hour and 15. And then what we're going to do is go to the second. We'll look at 8:30. And then a lot of you guys will ask me, just making sure this is all doing this. A lot of you guys will ask me how I like to frame up and mark up stuff, so you'll kind of get an idea of how that works here. And so you can always go back and pause the video and see the key levels that I focus on. There is and a few videos from now, so not this next video, but the next, going into the end of the week review. I'm gonna drop in my Telegram. If you guys are in the free Telegram, I'm gonna drop a document where you can follow along with these DRCs, right? Because just for example, like my DRC, just so you guys have an idea what it looks like. Let me do this really quick. All right, so these are what mine look like, right? So you guys kind of have an idea. And then do this here really quickly. Okay. And so those are kind of like what mine look like. So you guys will have a template that you'll be able to follow along with to answer those 4 questions. And I do think that that will improve um, a lot for traders. Okay. So we'll go back to charts here. And now, like I said, we're looking at so we're looking at that Wednesday, right? July the 2nd. Okay. So just so you guys have an idea again where that's going to be right here. Now, something I always do throughout the week is I'm going to mark the market opens, monthly opens, and all the points of interest areas. So let's just stick with the weekly open for last week. Okay. All right. This would have been the weekly open for last week. Market open here. Okay. So you have the market open, right? And then you have the day that we're actually analyzing here, which was, like I said, Wednesday the 2nd. So right here, 700 hours. This is where Wednesday's daily open was. right? And then we want to mark the New York session, okay, where that New York would have opened. So we got to mark that over here, which would have been here. Okay. And so, just so you guys have an idea, this is where Sunday's open was. All right. So I like to do a vertical line like this. This essentially right at this moment, for when you're looking at this on Wednesday, this would have been our high of week. All right. And so we'll go to the end of day of that Wednesday, right? So let's just stick to like this area right here. Because I'll go over this as well for Thursday's price, and then I didn't play Friday's July 4th price. All right. So this would have been the high of week. And then at this moment, right, for the daily open, this would have been the high of day. Now, why does this excite me so much for a capitulation bounce play? Right? It's because the Asian liquidity, right? The overnight liquidity, the location of where it was, right? So if you think about the week prior, we actually swept those lows on July 1st, right? So if you really look at that, there was a sweep of liquidity right here, and price started to rally into the overnight, right? Because it was the end of the day here on the 1st, around 11, 12, like that noontime price bounces right after capitulation, right? And selling and taking that low, and price people in those shorts basically were covering. And then overnight, they pushed that price up. They didn't continue to go for that New York price from that previous day, and price began to fall again. So the only new low that we had, right, because we had already taken that low from that previous week, was here, right? And so this set up a prime capitulation bounce play. And capitulation bounce play, guys, all it is just short covering at a massive rate, right? You're just going to see a whole bunch of shorts cover a position at a break of structure, right? Because there's only one way to make money on shorts. Well, there's not only one way, but there's multiple ways. But the way that we know, right, to get out no matter what on futures is you have to put a buy limit in or some kind of buy order. Okay. Okay, so now we focus on that price here. We were looking at that Tuesday low. So something I look at when I'm looking at Wednesday, right, is always going to be previous day lows and highs. I mean, it's just where liquidity is. It's not even really that hard to make it something that's harder than it is, right? So previous day low, all right, and then you had not only was we had the high of week, but this was the previous day high as well. Okay, at this area right here, because this was that high, price fell down, right? Capitulated, day ended. All right, so this was also the previous day high area. All right, previous day high. So high of week and previous day high. Okay. So coming into that price now, before New York was the most important part of the whole day, right? Because I don't look at the markets until 7 a.m. Central Time Zone, and I don't start actively looking for trades until around that New York Open. Now, sometimes what they do is they'll inject fear or a FOMO move around 7:30 with news excuse, right? They'll just have a red folder, something like that, and then that'll be the excuse to push price. And I believe we ended up having something like that right around 7:30, right? So like I don't play that 7:30. I like to see what's going to happen. So now you got to really truly think about it, right? Overnight price when you're looking at Wednesday, if you were short, ask yourself this question. If you were short right here, 22,770, and price fell below these equal lows for my smart money traders, right? Below this demand level in these areas here, right? And you're already at this point here. So you're already up, when you're talking about points, right? For NASDAQ, for my NASDAQ players, let's just say you got market open 22,750 and you went down even just to here. You're up about 112 points overnight, right? So the only way for this short to get out of this trade is to see two things happen. One, they're going to get that break of structure and trail risk down to this candle here. That's what I would do. Or they're going to see buyers step in and create support in the 22,610s, and they're going to start exiting those shorts by giving those buy orders over, right, to see the same thing happen. So why is this a great capitulation bounce play? Because one thing that's very great on a capitulation bounce play that makes it a lot the probabilities go up tremendously is a draw on liquidity, right? You want to see a draw on that previous day low, right? And so let me make sure that these are all coming up together like this. And so what you want to see, right, is that draw, and you have to be looking at higher time frames, guys. Obviously, you guys can see that. You have to be looking for that draw on previous day low. And so now it's all about timing as well, right? And location. Because what would a noob do if they were in this trade and they seen capitulation? They're gonna sell based off of emotion. They're gonna sell just because the market's falling, right? And so that's exactly what I wanted to see at 8 a.m. on Wednesday morning. And so right here, this is 7:30 to 7:45. You've got the lows taken. Now, there's a certain criteria I look for on an RSV setup at this exact point um, to see prices go back and take that HOD, which is going to be the biggest pocket of liquidity that we have, right? And so going into this here, let's go a little bit deeper here. Let's go 5 and 15. And really focus on the price. Okay. 7:30, 7:45, price is still hacking away at the left side, right? Price has not turned yet. The ICT trader at this exact point will wait for this shift in price delivery on the 5 minute to start actively taking this trade. And I'm going to show you guys why this was a great trade to take. And this at the New York Open. And this was also the trade I thought was that fear of missing out move that they kind of make you hesitant on what you want to do at New York because they've already given such a great trade pre-New York, right? So when you look at it, right, as soon as you get that draw on liquidity, maybe you'll use something like this to, kind of define like that area that, there was definitely a draw on liquidity, understanding that if you were to continue to try to short the market and the price is already below daily open, let's just say let's round up to 22,700. Price is already down 100 points in a day, and you're going to come in and short more at a major break of structure. Yeah, you know what I mean? Something's wrong. Right. Now, as I was looking at this, I like to look for certain things. I like to look for one sign of strength, and I like to look for mitigation inside that strength, right? And this is after the draw on liquidity, right? So your first sign of strength was 745 to 750. Then you had the mitigation on the smaller time frame, like 1 minute and lower, in that 750 to 755. And then you had that extension rally up 8 a.m. to 8:05, right? That shifted the price delivery, right? So if you look at the line graph, this is a shift in price delivery. You see how it's making lower lows, lower highs, lower lows, lower highs, lower lows, and bam, it creates a new high. So that's that shift in price delivery that I like to see. Now, if you have a rule like I like to have my rule, right? I'll play a CFD position down here for sure, but I don't personally like to play futures before New York Open. Okay. And so I didn't take this trade in here off based off my signal, right? At that draw on liquidity, I seen that price come up 8 a.m. We started getting our game plans together. I believe me and Tay were on a call. And then price came down here 8:15 to 8:20. Then you had 8:20 to 8:25. Then you had a little shift 8:25 to 8:30, and then boom, the open and price starts to rally up, right? Well, the other great area I thought was, a pretty good area was going to be this area, right? But here's how I see I'm just going to show you guys how most people were framing it up. This was New York Open, and they were putting their stop loss here for 35 points, right? And it's targeting HOD, right? Which is not bad, right? But after this move had already presented itself on that second candle, and then you had another, people who trade with me, they understand this, right? The sign of strength, second candle, and you've had this area, and you're playing up to HOD no matter what. You don't need to give yourself that much risk on the edge, right? You can use that down candle here, and this is what we really love to see, right? When the market or NQ specifically is presenting a 20-point risk, right, with a target, right, of an overnight liquidity for over 100, for really over 70 to 150 points, right? Because if I'm looking to take 70% of the move at all times, when price moves in my favor 100 points, I'm looking to scale 70 pretty quickly. If price moves 150 points in my favor, I'm pretty much looking to scale 100 points no matter what, right? Because the market's only going to give you so much in a day. And so this was a beautiful setup, right? And like I said, if you play that capitulation bounce play on futures, right, you don't go in with me personally, I'm not going to go in with max volume. I'm going to trickle into that. And as price is going down, right? So there's two things that happen in futures. If you're buying price when price is doing this and expanding and expansions, your dollar cost average from your initial move is going to rise, right? Like it's going to go up. It's going to go up. It's kind of going to go up. But if you let price develop, right, and you have like a move from down here, and then price capitulates and takes out liquidity, and you add in your contract back. Like let's say this for example happens. Let's say price goes like this, and you're already in the move here, right? Price extends up. You're like, oh, I don't know, and you have two contracts on. This usually happens to me all the time. That one, I will trail the risk. It'll knock me out of one. I'll be in one contract. Price will come back down to that accumulation, take some internal liquidity, not break the low. I'll add that contract back with the same stop loss low, and price will rally and take that high, and I'll be able to dump that contract, right? That's kind of like the scenario that happens for me all the time. And so that's the same situation that you're looking at here is that you could have been in a situation where you would have put one contract on. So let me show you, for example, really quick. Let me just do that really quick so I can do the replay mode. Right. So if you had, let's say you put on one contract here, right? Stop loss would have been at that current low. And then you're looking to take profit in this area up here. Now you're starting to identify the turn. And when you start to identify that turn after the capitulation bounce and draw on liquidity, you can start to really see what's called the RSV, the right side of the V set up to get to your target, right? And when to add and lessen to the order is very important. Okay, so like let's say you go here now, price starts to go up, it's going in favor here, right? Boom, explosion. Now for me here, this would have been an early order and you would have had a great dollar cost average on the move of the day. But here's where I think people mess up. When you're trying to add into a contract, you can't add in when price is going up, right? Because it's going to move that price up. So let's do this, right? So New York Open is right here. So what do people do here? If they add another contract, watch what it's going to do to your price. Bam. You see how that jump? Do you see the jump? Let me see if it'll just go back. Cool. So I'll have to do the replay over. But you see the jump in price, you actually lose from 22,600, 605s, let's say. You end up they even end up pushing your average to the 640s. So you've got to wait for price to actually be coming down, right? In this sense, like this. So you would have been in here at first. Price comes here, it has to come back down into demand before you add a contract back. Otherwise, that's going to happen to your price. Okay. And so you have to define edge is what I'm basically saying here, right? You can't. I mean, personally, the way I look at it, you can't go into it and not have an edge and just be putting your stop loss placement inside supply and demand on your orders. Okay. Okay. So we're back to here really quick. Okay. So we've seen how that draw on liquidity bounce capitulation bounce play looks right from a higher time frame perspective. Now, when you go into the New York order, you can see here 8:15. It's still pre-New York. They've got people in the FOMO, right? So the other move, like I said, that I would have framed up a little bit differently than what I was seeing online was you have 8:20 to 8:25, then 8:25 to 8:30 going into this candle. I'm seeing strength. ES is doing the same thing. I probably frame up this area like this, like I said, for that 20 to 10 point risk in this area here, just right on this 5 minute low, still targeting here, right? Now, what I will say is there's nothing wrong with taking a trade up here, right? But to me, this is extremely late when they've already given you a try here, they've given you a try here, and then you try it here, right? After it's already above daily open and kind of playing like from a higher time frame perspective, it's actually kind of playing very like you don't know which way it could go. This is very late, and then at this point, you've already created a new low, and been given another low. So just imagine your risk. There's liquidity, right? You're playing into liquidity's hands, but that's not saying that trade won't work, right? You're still going to be able to see the pop up, right? The close higher, right? The sign of strength on the 5 minute, which you want to see. And then as price starts to pull back into this area, yes, you could frame this up, or you could frame up something like this, right? With a risk, I would say like something like here, right? Which would be very, I don't like that because it frames you up already 25 points to the edge. And then you're still targeting the same area. Why? Because you want to be getting out of the markets when noobs are doing the opposite. right? Why would you want to give up expected value when you know up here is somewhere that you wouldn't personally start buying the market, right? And so it's not saying that this trade doesn't work. It's just saying that if you focus on getting your positions, like look now where this position is, location wise on the 15 compared to accumulation distribution, right? This is accumulation. Left side, guys, left side. All right. This is accumulation. This is you're buying trades in expansion and you're retail. That's just what it is. And you're late. You're late to the trade, the lazy trader, whatever, right? But you take on so much risk being a lazy trader, right? You're playing in a game of people who want to be elite. Like, so you can play lazy for so long, but this is a game where we're talking about a marathon. This isn't a sprint. So that's how it looks, from both perspectives, right? When you're looking at it like that, I thought the best move, the best chance to get it was in here. Or, like I said, if you played that New York position, possibly right in here, pre-New York as well, right? So it made it a very tough move that day and I would say would make a lot of traders probably late and just try to run the bandwagon up to the HOD. Right. Now, what we ended up getting delivered was what I wanted the previous day, right? I wanted to see the close on that Tuesday, July the 1st, and then price reach back up into where it ended up doing overnight for our Wednesday trade. But once we ended up pushing and getting more than HOD, I was actually personally out at HOD, 22,781.50s. That's 80 level as well. Algorithmically got in below a 20 level, so it just made sense to leave the market for what they gave me. Now there was some risk things that we could have done on that day a little bit differently, I would say, like on trailing the risk maybe to here and just letting the price continue out. But this was already 9:45, and then price pretty much went up and took that previous day in New York, as you guys can see with this wick right here. It took that little double top area of those New York shorts, and then just kind of fizzled out going into lunch, sold back down into a demand area of like 22,820s, and then continued to just grind higher and slower going into the end of the day. So, like I said, I think for the DRC, looking at, like I showed you guys some of my notes, the changes I needed to make from that day, what were the main ones here? The main thing that I wanted to show from this, DRC is just, when you're looking for that capitulation bounce play, you're looking for that draw and higher time frame liquidity, right? And when I say draw and higher time frame liquidity, all I really mean is you're seeing overnight shorts have to put buy orders into the market in order for them to make money on their position. It's order flow. It's how it works. There's no other way around it, right? And imagine trying to hold a position in a market that's always going up in technology, and that's a whole nother conversation, right? So, you know, like I said, when it comes to the DRC, I'll get you guys that template so you guys can follow along and kind of see, some of the, nuances that you're seeing in your trading and things that you can focus on. But that's how I was able to find, more setups and higher probability with these type of setups was by seeing that draw on liquidity and seeing those shorts cover to see that massive move back up because they're becoming weak-handed, right? They're deciding that they can't do this any longer. And just really think about it really quickly. These individuals started selling at 23:45. So if you're in Central Time Zone, that's going to be 11 p.m. at night. And they held this all the way into 7:15 in the morning. You think the market, now let's look at the higher time frame really quick. You think the market at that point was going to continue to sell off for all this? I had no idea, possibly. But at this exact moment, when you read and react, you already knew that once you got that draw on liquidity, that those shorts had two options. Either they trailed their risk down to cover more as it falls, into the next, 6 hours of that day, or they were saying they're done, they're ready to get out, they can't take it any longer, and price snaps back. Simple as that, right? So this is the DRC for Wednesday, July the 2nd. I'll go ahead and drop the one for Thursday, and then the end of the week review will have the rough draft of that template attached to it. And all you'll have to do is go through YouTube, and you'll be able to click inside the free Telegram. It'll be one of the pinned posts. So I hope this helped out with you guys and just kind of seeing that 5 minute candle, that 15, candle, that higher time frame understanding draw, and then maybe how to maybe frame that risk a little bit better. Like I said, maybe not putting your risk inside of another demand and just really defining the edge, which will obviously make you more available and not having you risking so much on the setup. So you guys have any questions, let me know and just shoot them to me on Instagram. Appreciate you guys. Have a good one.